Welcome back to the channel, everyone. Today I want to talk about how the Fed is absolutely out of control and how margin calls are likely coming very, very soon. And obviously these margin calls are great news for the AMC squeeze. So guys, stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Occupy the Fed Reserve tweeted saying breaking news. The Fed made more than $17.5 trillion in stealth repo bailouts from January to March 2020 during the pandemic. That included a $3.84 trillion bailout to one singular bank, the trading arm of France's BNP Paribas. Now, this is in addition to the $20 trillion in repo bailouts performed between October and December 2019 during that liquidity crisis. And Occupy the Fed Reserve said, as many recall, BNP's overexposure to the subprime mortgage derivatives was one of the first catalysts of the great financial crash. Of course, they wanted $3.8 trillion in repo bailouts at great risk to US taxpayers. And guess what? Banksters are still massively overexposed to derivatives. Nothing has changed. The Fed claims tens of trillions of dollars in illicit stealth Wall Street repo bailouts was just about market liquidity and providing support. But obviously this isn't just normal provision of liquidity because the Fed hasn't performed a repo of this sort since December 2008. He said the Fed is backstopping the risk. Shadowy quadrillion-dollar plus global derivatives markets are a great risk to the US people. And you may say, why do cumulative repo totals matter? Because they're rolling over trillions in non-market, nearly 0% interest loans to potentially insolvent firms. The Fed is literally giving trillions and trillions of dollars for free to these banks which are practically insolvent because the amount of risk and dangerous derivatives that they've taken on. Now, this chart shows a number of banks that received these stealth repo loans during the pandemic. Barclays, for one, received $2 trillion directly from the Fed. Now, obviously, BNP Paribas received $3.84 trillion, but on top of that, Citigroup also received $2.67 trillion, Goldman received $2.85 trillion, JP Morgan $3.6 trillion, and Nomura $2.7 trillion. It says as thousands of businesses were forced to close in the US as a result of the pandemic and millions of Americans were financially struggling, the Federal Reserve was pumping what would become a cumulative $3.84 trillion in secret repo loans into the US trading unit of the giant French global bank BNP Paribas. Now, it says the repo loan market is where banks, brokerage firms, mutual funds and others make loans to each other against safe collateral, typically treasury securities. Repo stands for repurchase agreement. The Fed only comes to the rescue of this market when there is a liquidity crisis and Wall Street firms are backing away from lending to each other. September 2019 was the first time the Fed have had to intervene in the repo market since the financial crisis of 2008, and it was months before the pandemic was discovered anywhere in the world. And it says what may have led to the scramble for money by BNP Paribas Securities is, wait for it, risky derivatives, the same financial weapons of mass destruction that blew up the US financial system and economy in 2008. Now, obviously, these same risky derivatives are used by these over-leveraged longs to take massive long positions in the stock market well above their risk tolerance. And again, these risky derivatives are also being used to short both AMC and GameStop because these derivatives are being used to hide true short positions. Now, the BNP Paribas information and this overall chart comes directly from a repo loan data dump by the New York Fed themselves. And it says the Fed has withheld the release of the names of the banks that got these massive loans for 2 years now, but it's forced to release them under the provisions of the Dodd-Frank financial reform legislation of 2010. Now you may say, Tom, these repos and these reverse repo loans only happened in the very first quarter of 2020, right? Surely they can't still be happening to this very day. Well, you've probably also seen me talking about the reverse repos for some time now. On Thursday, we hit a new recent high of $1.87 trillion in reverse repo loans. That's only overshadowed by the all-time high on the 31st of December 2021, where we had $1.904 trillion in reverse repos. And obviously, if we look at this chart of reverse repos, which is trending upwards, the moving average has now eclipsed that December high. This red line shows that moving average of reverse repos performed, and now the moving average has just set an all-time high, eclipsing those previous December highs. I don't think it will be long until we breach that $2 trillion in reverse repo loans. And again, these reverse repos and stealth repo loans aren't the only thing that shows the Fed is absolutely out of control at the moment. Gavin tweeted saying the rally in the last 2 weeks was most likely funds trying to make up for their Q1 performances. Guys, if you didn't already know, Moomoo and Futu have just officially announced that Futu does not accept payment for order flow, and therefore you don't have to worry about your buy orders going through sketchy dark pools or being given to Citadel. Right now, if you sign up to Moomoo, you can currently get 5 free stocks worth up to $3,500 each. All you have to do is sign up to Moomoo, use the link in the description below, and make your first deposit. Moomoo also recently won the award of Best Trading Platform at the FinTech Breakthrough Awards. Moomoo is also entirely commission-free, has tons of technical indicators and advanced charting tools. Moomoo publishes daily short-selling data, position cost distribution, and much, much more. Moomoo is also incredibly easy to use, is very customizable, and will help you to trade like a pro. So guys, be sure to sign up to Moomoo using the link in the description below to get up to $70,500 in free stocks. I think these funds have effectively been propped up by the Fed to show a strong Q1 performance, even though the S&P 500 took a massive dip in January and February. Effectively, the Fed and these hedge funds pumped the S&P 500 over the last month to show a strong Q1 performance so that investors don't withdraw their cash. He said Q1 ended yesterday with 2 days to settle. The last day would have been Tuesday, March 29th. Coincidentally, the same day this short-lived rally came to an end. So basically these trades from Tuesday, March 29th won't clear until the 31st of March, aka the end of the month, and therefore these hedge funds can still report strong Q1 earnings. And therefore it would not surprise me if the market crash continues in April and these liquidations and margin calls start flowing in. And on top of that, we're seeing tons and tons of trading halts because over 208 Chinese companies are unable to provide audited books. Over 100 Chinese property developers and others have been suspended from trading indefinitely. This screenshot shows that this year, over 208 companies so far in China have failed to provide audited accounts and are now suspended. Firms such as Evergrande, Sunac, Modern Land, Logan Group, Shimao, Kasia, Agile Group, Link Holdings, and many, many other Chinese companies have failed to provide audited accounts and aren't releasing their figures. Now again, I think this is another sign of the Fed acting irresponsibly and being absolutely out of control because they will not allow these Chinese companies to default on their US dollar debt. By allowing these companies to evade default, obviously the Fed believes they are saving the US financial system because obviously these Chinese companies have borrowed so much money from the US that a default would cause havoc on the US banking system. But really, by allowing these companies to avoid default, it's effectively making it even worse because these companies can continue losing more and more money and can continue borrowing money from other unsuspecting sources. Obviously, the Fed and the large US banks are helping these Chinese companies to avoid default so they don't have to recognize these Chinese losses. But again, it's just making it even worse because now these US banks can continue borrowing money against their Chinese debt and can continue taking out more risky derivatives. But as Gavin tweeted, the Tiger Global hedge fund has sunk 34% this year as key stocks fall. SoftBank has liquidated most of its portfolio at the Nasdaq Whale unit. And he says, so it begins. I think Tiger Global are going to be a bigger version of Archegos Capital Management, which could end up causing the entire US market to crash. Obviously, back in March of 2021, Archegos Capital Management defaulted, with many of the large US banks losing billions and billions of dollars, and many US stocks crashing up to 90%. Tiger Global is obviously significantly larger than Archegos Capital Management and is likely to do much, much more damage. But in terms of AMC, I believe that Diane Garrett, the CEO of Highcroft Mining, is giving us a bit of a sign. If you hadn't already seen, Diane is wearing a rocket ship pin on her blazer during an interview suggesting that HYMC and AMC are likely to be going to the moon. And guys, I also wanted to quickly talk to you about options for AMC and whether options help the squeeze or whether they harm the squeeze. Now I'm going to read a bit of a thread from Darkpool and then also give my opinion on top of that. Darkpool said, I don't care if people want to buy and hold, inexperienced investors should not aimlessly buy options because you will get burned. He said, what I do care about is that short sellers are spreading that options are giving money to Citadel and they'll just hit max pain and take your options because Darkpool believes that's completely false. He said, if you still think this is all Citadel's doing, then you are not paying attention. I've dove into short sellers' short reports and found that they download the options chain in order to either A, see if there's unusual options activity that would likely spike a gamma squeeze. This is an extract from one of those short reports that says, remarkably, things got even worse than this in the first quarter. The aggressive buying of short-dated options produced the gamma squeeze. The idea was that short-dated options could force market makers to buy huge quantities of stock if the stock was to rise. And said the most important variable for many stocks became open interest in weekly options. Now obviously that is suggesting that these short sellers are scared of short-dated options because mass buying of these options can cause a gamma squeeze as many market makers have to buy massive quantities of shares. And he also said that these hedge funds download the weekly options data to B, hit max pain and neutralize the options chain. You need to break this down because it's not just us versus Citadel. He says Citadel is solely the market maker and they have to delta hedge options in case an investor wants to exercise. Data hedging happens on the lit exchange. And he said short sellers posed as quants that worked at Citadel and said to keep buying options because we'll take your money. They don't actually work at Citadel, they work at these research firms and they are happy that their anti-options FUD campaign has worked. And again, this is an extract from one of these short sellers that says the most excessive sign of retail mania, massive investment of short-dated, far out of the money call options, has slowed dramatically. And they said we are far less scared of a gamma squeeze in one of our names than we were back in February. Therefore, by not buying options, we are effectively removing the possibility for a gamma squeeze entirely. You can't get a gamma squeeze without any options because obviously options create gamma, which creates the volatility in the stock because these market makers have to hedge for all of these options being purchased by buying real shares. And he said when the options chain is clear, it gives short sellers the ability to control the price through derivatives the other way because they can actually short the stock. Obviously, a hedge fund can short by borrowing shares, but a better way to do it is to short the stock by buying put options because that creates gamma in the opposite direction. But a better way to short the stock is by selling covered calls directly to unsuspecting retail investors, but the best way to short the stock is by selling naked calls to those retail investors without ever actually owning the stock. But this leaves those hedge funds and market makers in a massively unsuspecting position because they've sold tons of call options and they don't actually hold any stock. Obviously, if AMC starts to rise by retail investors buying more stock and more options, it means those market makers have to go into the market and hedge for their naked calls by buying actual shares in massive quantities. And he said what shocks me the most is how well the campaign spread after the most beautiful gamma squeeze I've ever seen on June the 2nd. Cost to borrow was high, the stock was 100% utilised, and there was a huge amount of open interest on the $20 and $40 calls. Obviously, you can see here back in January 2021, we had a gamma squeeze as there was a massive amount of open interest. We then had months and months of buying and holding, followed by a massive gamma squeeze again caused by tons of open interest in the options chain. And again, just over the last week, we had tons and tons of open interest on those $40 and $50 calls. And again, the price of AMC ran again down from $15 all the way to at one point nearly $35 per share. But the incredible thing is the open interest in last week's options chain was absolutely nowhere close to what we saw back in June of 2021. In fact, it was less than 1/10 the amount of options that we had back in June. Back in June, there was around 1.5 million open interest in call options, but last week there was only around 150-200,000 call options. Now, I personally do think that options will be very, very important for the squeeze, but I do think we have to strategically time the options purchases. Again, if we start purchasing the massively far out of the money call options, like the $60 calls, while the price of AMC is falling, that is not going to help the squeeze and we are effectively going to lose our money. Obviously, while the stock is falling, there's not much point in buying these options because obviously it doesn't help, as the hedges will just push us underneath max pain and our options will expire worthless. But when we have circumstances like last week, when the price is rising at great speeds, I think options are the perfect time then to add to the speed of the increase in the AMC price and effectively cause a gamma squeeze, which could end up causing a short squeeze. When the price is running, tons and tons of our call options will be in the money and will have massive amounts of unrealized gains, at which point we could even exercise those call options directly for those AMC shares, and the market maker will have to go into the market and buy all of those shares. I think last week when we had an open interest of 150,000 call options, if everybody jumped on those call options and pumped that number from 150,000 to 1.5 million call options, when the price of AMC ran from $15 to $25, we could have had a massive breakthrough of the $30, $40 and $50 regions of resistance. And again, I think if we managed to coordinate that mass buying in options, it would have thrown us through that $50 region, and effectively AMC would have been running so fast that we would have caused a gamma squeeze and would have caused a short squeeze. Guys, be sure to let me know down in the comments below whether you think the Fed is out of control and whether you think that buying options is good for the squeeze. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.